Hey, welcome back, options traders. Well, a question that I get from a lot of traders is how can you quickly tell what a risk graph is going to look like if you switch it from long to short or from calls to puts? And a lot of that just comes from experience and working with it. But there are some nice little shortcuts you can do. There's a neat little trick you can do by looking at the symmetry of a risk graph. So, what does the risk graph symmetry reveal? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, there's really two types of symmetry. There's a horizontal symmetry. So if you think of your risk graph at that zero line, that zero profit and loss or break even, if that zero line divides your risk graph symmetrically, in other words, they look like mirror images of each other, then they are horizontally symmetrical. And that is going to be indicative of long and short positions. However, we can also have vertical symmetry. So if you can draw a vertical line from let's say, the top of the graph down through the bottom, and the left half looks like the right half, or in other words, we're putting a mirror right between them vertically, then that's going to be the difference between calls and puts. So for example, here I've got a long call in blue, 100 call. There's our bend at 100, and we also have a short 100 call in red. Notice that both bend at the same strike because they're long and short the 100. You can think of the red graph as the trader on the opposite side of the person of the blue graph. The blue graph is the buyer, the red graph is the seller. They will both break even at the same spot, so they're going to cross over right there. But notice that they are symmetrical around zero. So if we just were to divide the graph this way, the top half looks exactly like the bottom half. And so when you see that, that's the difference between a long and a short position. So here's the way that you want to visualize it. If you see this as your risk graph, just think of it as if it's a piece of paper sitting in front of you and you are going to flip it vertically from top to bottom. So watch what happens if we just flip this over, then that's going to be the short call. If this were instead our risk graph, we would flip it from top to bottom, and then that becomes the long call. So you can see by just flipping it back and forth, top to bottom, you're simply switching from long to short. On the other hand, if this is our risk graph, a long call, notice that we could also look at the put. We could look at a long put with the same strike, 100 put, and we can draw a line vertically right there at the strike. And now do you see how the symmetry is left to right? It's as if we have a mirror here right between them. The left half looks like the right half. See, before we saw the top half look like the bottom half. Now we're looking left to right. And if that's true, that's indicative of calls and puts. So for example, if this is your risk graph, we know that this is a long call. We're just going to take this piece of paper, this risk graph, we're going to flip it left to right or horizontally, and that's going to switch us to puts. So if this is the risk graph for a long call, I can visualize and see that the long put is going to look like this. Let's try a more complicated one. Here is a short ratio spread. So perhaps we buy the 100 call and sell 2 of the 105 calls. That's the resulting risk graph. It's considered a short spread because of the unlimited risk. So if we were to take the opposite side of the trade, in other words, the long spread, sometimes called a back spread, it would do this. We're just going to flip it from top to bottom. On the other hand, if we were to look at that same risk graph, remember this is a short call ratio spread, what would happen if we used puts? Now we're just going to flip it left to right. And so now our risk graph is going to look like this. So that would be a short ratio spread with puts. What would the long one look like? Well, again, remember long and short is flipping it vertically, so the long put ratio spread would look like this, or the back spread. So this is really a little tool you can use, and it's very handy when you get into more complex strategies. So recently, we looked at a seagull and a Super Bowl strategy, and I showed how they sort of have similar shapes. But by looking at the Super Bowl, how can I make it look like the seagull? Well, one thing I can see is that the right side of the seagull graph has unlimited gains, whereas the right side of the Super Bowl is flat. But notice that the Super Bowl on the left side has unlimited losses, whereas the left side of the seagull is flat. So they're in a way kind of inverse of each other. So what I can do is I can just look at this and say, well, if these were, let's say, two pieces of a puzzle that I'm trying to fit together, the first thing I can tell is let's take the Super Bowl and do it with puts. That's going to flip the graph left to right. And now that's going to be the Super Bear. I can see that I've almost got it. It's just that it's inverted. So I would need to sell this. So if we flip it from top to bottom, we get that. And that is a short Super Bear, which now looks exactly like the seagull. So that's a neat little technique you can use that can certainly help you, whether you're just getting started with options or have been trading for a long time. Many times you'll want to convert long to short or calls to puts, and that's a real easy way to visualize it. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.